Titled Sound Monetary Policy. I now recognize myself for 5 minutes to give an opening statement. Before joining our Financial Services Committee in 2013, I had to learn a new language, Fed speak. One of the first words I learned is headwinds. Translated for the layperson, headwinds means unconventional monetary policies promised a lot, but delivered little on what really matters, economic opportunity for every American. In recent testimony, the Federal Reserve Chair cited slow productivity as a headwind. Specifically, she said, "We are not able to address every problem. If there's slow productivity growth in the United States, that's not something that the Fed has much ability to address." Sharing a widely held sentiment among economists, the Wall Street Journal recently characterized slow productivity growth as, quote, "the biggest factor affecting Americans' living standards," unquote. Yet Chair Yellen questioned if there's slow productivity growth. The data are clear. Productivity growth is remarkably slow. Yet Chair Yellen chalked it up as a headwind. According to her testimony, that's not something that the Fed has much ability to address. I disagree. Almost 8 years out of recession, the absence of sound monetary policy continues to weigh on productivity growth and the economic opportunities it can offer to every American. Testimony from today's hearing will show us a better way. The longer we go without a reliable strategy for monetary policy, the longer households and businesses will continue losing their direction in the thickest of economic fogs. Absent clear price signals about when and where goods and services can find their most promising opportunities, productivity will continue to fall well short of potential. Today's monetary policy is data-dependent in name only. It is a policy that never tells us what data matter, let alone how they matter. It is a policy that continues to leave households and businesses scratching their heads about when and where the oracles from the Fed's Eccles building will turn next. It is a policy that creates uncertainty instead of clarity. It is a policy that has weighed on productivity from its start a decade ago. Slow productivity growth cannot be dismissed as an unavoidable headwind. It is time to ditch the Fed speak. Productivity demands clear monetary policy. The longer the Fed continues to leave us guessing about where policy will move next, the longer the malaise of Obamanomics will linger. As the chart on our hearing room screen shows, each year of President Obama's administration saw the ceiling on economic opportunity drop sharply. For 5 straight years, productivity did not rise above 1%. Unfortunately, as the Fed's policy fog kept getting thicker, Americans saw their untapped potential grow faster than their economy. Ignoring this clear signal that unconventional monetary policy had stopped working, if it worked at all, the Fed decided last December to extend its unprecedented streak of sub-1% policy rates to almost 100 straight months. For years, so-called forward guidance has served better as a fog machine than a clear communication program. Throughout, the Fed told us that policy rates will gradually rise to more conventional levels, but always found a last-minute reason to pull back. According to the Wall Street Journal, bad news delayed rate increases, but good news didn't speed them up. Central bank officials began both 2015 and 2016 projecting 3 to 4/4 percentage point rate increases, and in both years delivered just one in December. A few weeks ago, the Fed decided to hide yet again behind policies that depend on the data in name only. This time, while central bankers have been characterized as loath to tighten policy when the market is not anticipating such a move, the Fed did just that. Absent any substantive change in the data for inflation or employment, the Fed surprised again by spiking expectations for what became yesterday's rate increase. The Committee on Financial Services is dedicated to a set of monetary policy reforms that will blow away the lingering policy fog, reforms that will bring monetary policy back into the sunlight so that transparency and discipline can help all Americans finally get back on track. I look forward to testimony from our panel of accomplished business, policy, and academic leaders. Their counsel will help us not only jettison a decade of interest rate and balance sheet policies that distort economic decisions and threaten policy independence, but also establish a reliable strategy that supports economic opportunity for every American. The chair now recognizes the ranking